Good afternoon, dear ladies and gentlemen. I'm glad to welcome you at this presentation. My name is Roustam Vakhitov, and I'm an associated international tax partner at Crowe Azerbaijan. Today, we are going to discuss the interesting and very important topic of Pillar 2, with a particular focus on taxable profit adjustments under Pillar 2 legislation. Let's begin the presentation, keeping in mind that we'll move rather quickly, considering the time limitations. Slide 2. The guidance for understanding this subject can be likened to studying Sun Tzu's well-known work, Art of War. However, the correct technical translation of this piece is A Methodology of War. It's important to note the difference between methodology and art. Art presumes a certain level of exclusivity and very special skills, while methodology is something that anyone can learn and apply. Pillar 2 is not an exception to this, despite being a rather difficult subject to grasp. I would like to express my gratitude to BIBF for kindly allowing us to continue our collaboration. We had a very positive experience of cooperating with BIBF in the year 2024, thanks to the support of Mr. Rizvan and Mr. Farouk. This collaboration provided us with the opportunity to be an information partner and run a highly successful moot court competition on international taxation. The competition featured esteemed experts in the field, such as Kees van Rath and Philip Baker, as well as respected institutions like BIBF. My appreciation and words of gratitude go out to all these partners and supporters. Slide 3. Pillar 2 is a rather complicated subject, so let's do a brief recap of what the Pillar 2 rules are about. The topic was under discussion for quite a number of years, but it progressed very quickly as of 2021, when the OECD reached a historic agreement on a two-pillar approach to reform the international tax system. Slide 4. The two-pillar approach was a trade-off between Pillar 1 and Pillar 2. Pillar 1 focused on expanding source-based taxation rights, allowing countries to tax large multinationals, primarily US-based giant IT companies, on profits earned in their jurisdictions without physical presence. Slide 5. Meanwhile, Pillar 2 sought to limit tax competition by introducing a global minimum corporate tax at the rate of 15%, calculated on a country-by-country basis. The policy intent behind Pillar 2 was to ensure that all large multinationals pay a minimum level of tax on their global profits and to target base erosion and profit shifting to low or no tax jurisdictions. However, the downside of Pillar 2 is that it makes tax competition harder by simply eliminating quite a lot of tax incentives. Let's consider a simplified example of how this works. Suppose we have several Bahraini businesses, one of which has profits of 100 million Bahraini dinars. Half of this profit is a dividend distributed by its Bahraini subsidiary, which has profits of 200 million Bahraini dinars with zero tax on it. There is also a third group entity with profits of 300 million Bahraini dinars. And presuming it's in the oil industry, let's say the effective tax rate is 9%. The blended effective tax rate, ETR, across all the Bahraini entities is just 4.5%. calculated as 27 million divided by 600 million. Under Pillar 2, the top-up tax would be up to 63 million Bahraini dinars, bringing the ETR to 15%. This is not just a Bahrain issue. Any jurisdiction where multinational entities operate with an ETR below 15% is exposed to this situation. If the ultimate parent entity's jurisdiction implemented the income inclusion rule, under the Pillar 2 global rules, the undertaxed profits would be taxed in that jurisdiction. In our example, this would be the Netherlands. The question arises, who will get this money? Will it be the Netherlands, where the ultimate parent entity is located, or Bahrain, where all the activity is taking place? If Bahrain doesn't impose this minimum tax, the Netherlands would simply take the money, which is not a particularly fair outcome. Slide 6. Recognizing this reality, many countries, including Bahrain, have already started implementing Pillar 2 compatible domestic minimum tax. The goal is to exercise taxing rights over undertaxed profits in their jurisdictions before other countries can claim them. Bahrain's Pillar 2 legislation was implemented in 2024 with effect from 2025. It consists of a Decree Law number 39, effective from 1st September 2024. A regulation issued on 11th December 2024, and clarifications from the National Bureau of Revenue, NBR, on 16th January 2025. We don't have time to go through all these publications in detail, but I have prepared a folder containing these documents, which you can access either via the provided link or QR code. Slide 7. I have also created an AI assistant, accessible via another link and QR code, which can help you navigate through this legislation. However, it's important to check the responses provided by this solution, as AI can sometimes give wrong answers. Slide 8. While Pillar 2 implementation is moving ahead in most countries, it's worth noting the recent developments in the United States. The Trump administration, having all rights to do so, decided to focus on national interests and priorities. One of the first decrees issued by this administration essentially states that the global tax deal no longer has force in the United States. How other countries will react to this development remains to be seen, but the situation is rather fluid. Slide 9. The dichotomy between Pillar 1 and Pillar 2 is one thing to consider. Another development is the relocation of manufacturing activities from China to other countries. This is a comment made by my friend and U.S. tax expert David Berinsky during one of the recent discussions and conferences.
Had 100% of the manufacturing in China. They have now moved a lot of the production to Thailand.
Slide 10. For those who are interested in learning more details about this topic, I encourage you to watch the full recording of David's presentation by accessing it through the provided QR code. Slide 11. For China, it would be important to try to keep foreign investments. China's GDP has grown tremendously over recent years. The map on the left shows Africa's GDP per capita in 1980, with most countries producing more GDP per capita than China. However, by 2016, the situation had drastically changed. Now there is a reverse process, and China might be losing some of its investments. Tax incentives are one of the most efficient ways for China to try to retain these investments, although this approach is not really in line with the Pillar 2 concept and philosophy. Slide 12. Whether China and a number of other countries would follow the Pillar 2 philosophy is yet to be seen. We are going to witness many interesting developments in this regard. Slide 13. Before we delve into more details, it's worth noting that most of the foreign direct investments in Bahrain come from countries that have not implemented the income inclusion rule. Basically, if a company is located in Kuwait, Saudi Arabia, or the United Arab Emirates and has invested in Bahraini businesses, these countries would not tax the non-taxed Bahraini profits. This is another factor to consider, and we will discuss this in more detail shortly. Slide 14. Now let's move on to the main subject of our presentation: taxable profit adjustments. It's important to understand how the calculation of tax works under Pillar 2. In principle, it's not a matter of taking all the profits within the jurisdiction and imposing a 15% minimum withholding tax. Instead, there are a number of deductions to consider. Some of the most important and significant deductions include the deduction for qualifying dividends received and the deduction for exclusions, which is a notional deduction based on assets and payroll. This deduction is based on a percentage that ranges from 5% to higher amounts and decreases over time. Currently, in Bahrain, there is a deduction of 9.6% for payroll expenses and 7.6% for tangible assets. There are a number of other deductions that we won't go into detail about because they are subject to adjustments and are rather technical. However, the whole concept is to take the profits, make certain deductions, and then apply the minimum tax rate to this adjusted tax base. Slide 15. The substance-based income exclusions are an important aspect of the Pillar 2 calculations. These exclusions are linked to payroll and assets, with percentage deductions varying between 10% and 5% for payroll, currently 9.6% in Bahrain for 2025, and between 8% and 5% for tangible assets, currently 7.6% in Bahrain for 2025. Slide 16. The key adjustments for taxable profit under Pillar 2, as per the regulation issued on 11th December 2024, include several categories. The first category is tax accounting adjustments, which cover net taxes, excluded dividends, equity gains and losses, revaluations, asset disposals, foreign exchange gains and losses, expenditures, prior period items, pensions, and tax credits. The second category is financial instruments and transactions, which includes debt and equity classification, hedging gains and losses, intra-group financing, debt releases, dividends, and additional Tier 1 capital. Slide 17. The third category of adjustments is assets and liabilities, which covers immovable property gains, stock compensation, fair value accounting, and carrying value differences. The fourth category is multinational group transactions, which includes consolidation, transfer pricing, equity investments, and inconsistent transaction amounts. The fifth category is sector and industry-specific adjustments, covering insurance, shipping, and permanent establishments, as well as flow-through entities. The sixth and final category is deferred taxes, which includes total adjustments, loss assets, post-filing changes, and transition year computations. For full details and conditions related to these adjustments, please refer to Articles 10 to 36, 39, and 91 of the relevant legislation. Slide 18. Let's consider an example to illustrate how these adjustments work in practice. Slide 19. Suppose we have financial data for Bahraini entities with a total profit before tax of 300 million Bahraini dinars. The tangible assets of these entities are valued at 200 million Bahraini dinars, and the payroll costs amount to 240 million Bahraini dinars. The dividends received, which are fully excluded, total 50 million Bahraini dinars. The tax paid in Bahrain is 9%, which amounts to 27 million Bahraini dinars. Slide 20. According to the regulation issued on 11th December 2024, the applicable exclusions for this example are as follows. The tangible assets exclusion rate is 9.6%, the payroll exclusion rate is 7.6%, and the dividends exclusion rate is 100%, meaning that dividends are fully excluded if the specified criteria are met. Slide 21. To calculate the excluded amounts, we multiply the tangible assets by the exclusion rate of 9.6%, resulting in an exclusion of 115.2 million Bahraini dinars. For payroll, we multiply the payroll costs by the exclusion rate of 7.6%, resulting in an exclusion of 18.24 million Bahraini dinars. The dividends are fully excluded, amounting to 50 million Bahraini dinars. Slide 22. To calculate the excluded amounts, we multiply the tangible assets by the exclusion rate of 9.6%, resulting in an exclusion of 115.2 million Bahraini dinars. For payroll, we multiply the payroll costs by the exclusion rate of 7.6%, resulting in an exclusion of 18.24 million Bahraini dinars. The dividends are fully excluded, amounting to 50 million Bahraini dinars. Slide 23. To obtain the adjusted taxable profit, also known as the GloBE income, we take the total profit of 600 million Bahraini dinars and subtract the tangible assets exclusion of 115.2 million, the payroll exclusion of 18.24 million, and the fully excluded dividends of 50 million. This results in an adjusted taxable profit of 416.56 million Bahraini dinars. For the final qualified domestic minimum top-up tax QDMT calculation, we apply the Pillar 2 minimum tax rate of 15% to the adjusted taxable profit, which gives us a minimum required tax of 62.48 million Bahraini dinars. The actual tax paid in Bahrain at a rate of 9% amounts to 27 million Bahraini dinars. Therefore, the QDMT payable in Bahrain is 35 million Bahraini dinars, which is fully covered by the existing tax payments. Slide 25. Think about the measures that Bahrain could apply to make its economy competitive while adhering to the Pillar 2 framework. The aim would be to help the domestic economy maintain its competitive advantages and benefit from cross-border investments and foreign investors. That concludes our presentation for today. Thank you very much for your attention. I would be happy to discuss this topic further, and you can find my contact details on this slide. Let's continue the discussion on these important matters.